The stock market is in big trouble, folks. We are starting to see a continued decline in both the NASDAQ, the S&P 500, and even small cap stocks as measured by the Russell 2000 index. All this is coming in the context of the 10-year Treasury yield now seeing levels we have not seen since 2007. We're almost about to hit 5% interest rates, which is leading the question as to whether or not right now is still the good time to be in the equity markets, or is it better to invest in bonds which have cratered over the past 6 months. So just remember that if you're seeing red in your portfolio over the past 2 months, not only is it cyclical and seasonal, which has always been this time of year, but it also has to do with an impending rise in interest rates where market participants are essentially trying to price in the worst about the Fed keeping its rates higher for longer. And the thing is, folks, we all know that high interest rates are not bad inherently for stocks and profitability. The issue arises when you're going from one place to the other, which is low interest rates, to high ones. And that shock is what is hitting the system and what investors are trying to price in, particularly with what you see on screen right now, which is a 10-year Treasury note. As this yield goes up and ticks up every day, the bond prices of that yield collapse. And since bonds are known to be some of the safest assets, it is a sign that overall interest rate expectations are still really high. As a matter of fact, as I'm filming this video, something else that is considered very safe, which is the Dow Jones, has just turned red for 2023 with a broader decline in all markets right now. And yes, although most of the large cap stocks of the top 7 of the NASDAQ, like your Metas, your Teslas, your Apples, and Amazons, are doing kind of okay during this pullback, the rest of the market is getting destroyed underneath the rug. And we're starting to see that not only by looking at the Fear and Greed Index, which is now ticked into the extreme fear section for the first time in well over 8 months, but through how a specific sector of the market is underperforming. And that sector, folks, is none other than your utilities, which supply gas, power, and electricity to all the homes in the country and are regarded as some of the most profitable, safe, and stable businesses in North America. And as you can see, the utility sector of the S&P 500 is now down a whopping 10% over the past 1 month, far exceeding the declines of anything we're seeing in the NASDAQ or the S&P 500. And particularly speaking, the one stock that is leading this route to the downside, and also potentially the routes you see in your small cap stock portfolios, is NextEra Energy, ticker symbol NEE. This stock has now wiped out over a quarter of all of its market cap just over the past 2 months, alongside other utility companies like AES. For those that are unfamiliar to the industry, realize that this event is extremely rare. NextEra doesn't just tank by 25% if there was not some serious economic damage being done, and right now, all that is being done by rising interest rates. This doesn't necessarily mean that the markets are going to continue to decline, but it does mean that the economic situation is going to get a lot worse and potentially stay relatively stagnant for the next year or so, which should do well for reducing any form of growth expectations. For those that don't know, NextEra Energy is the world's largest electric utility. What that means is the way you get power to your house or your office space is most likely coming through a transformer or a distribution network constructed by NextEra Energy. The company does more than $22 billion in annual sales with income of $8 billion, making it one of the most profitable utilities on planet Earth. And that profitability and stability can be seen extremely well with the way that the NEE stock has performed over the past decade. During every single recession, correction, or pullback, we have seen NextEra stock actually perform really well, where it protects downside investors, but also gives decent enough rewards when the market starts to run to the upside. And even during the interest rate hikes of 2022, the stock remained extremely poignant and did not sell off nearly as much as the tech stocks until now. NextEra Energy is supposed to be a stock you put in your retirement and forget about. It's supposed to be a stock you simply buy and hold, but now it is trading like a meme stock and leading basically every other EV, energy, hydrogen, or electric utility stock down, as clearly seen by the rout we're seeing in stocks like Sunrun, Plug Power, Marathon Digital, Nikola, Bloom Energy, and Plug Power. And as for why exactly this might be happening, well, look no further than interest rate hikes scaring investors out of any potential growth and profits these utilities might see. For those that don't know, electric utilities use a lot of leverage to finance their projects, whether that be a solar farm, a wind array, or a new transmission line for connecting an offshore wind power plant. It takes a lot of money, and the cash available that NextEra has is simply not enough. As a result, NextEra not only provides a massive amount of jobs in the construction space, but also in the financing space through all the banks that the company works with to lend it good amounts of money. And well, folks, as we just learned last week, NextEra actually slashed its forecast by just a little bit for growth in 2023, as well as reducing its dividend outlook for the rest of the next 12 months. This has wiped out more than $100 billion in the NextEra market cap since its peak, resulting in price target cuts and a lot of headaches for investors and retirement fund owners who own this stock in their portfolios. Utility stocks tend to perform really well and give some of the best yields in the form of dividends. But now that we are seeing short duration treasuries as well as long duration ones collapse and yields skyrocketed, the attractiveness of those dividends is also going down, which is exactly why we're seeing this crash in the utility and NextEra sector. As a matter of fact, the crash in the bond market since 2020 is indeed longer and more severe than the crash that we have seen in the stock market in 2009, which just goes to show you the unique situation we're looking at right now for markets. We are now on track to see this third consecutive drawdown year for bonds in the US, and no other major economies on earth have been spared either, with the likes of Japan, Germany, Italy, and Australia also leading the way in their bond market destruction. Now, although bonds going down are not a great thing, and certainly we have seen the ramifications of that with the sell-offs in stocks, the bankruptcies over the past 12 months, as well as the collapse of something like Silicon Valley Bank, it also is an opportunity to invest, even though right now it obviously doesn't seem like it is one. Because remember, although right now clean energy stocks, hydrogen, electric vehicle stocks are taking a big hit because of rising interest rates, which increases borrowing costs and reduces the ability for companies to invest in themselves, it is also a signal that the economy and the Fed is at its tightest economic standpoint that it has ever been. Again, we know that inflation has fallen since the start of the year, although it has ticked up a little bit because of oil prices in August. But anywhere interest rates go from now on is going to be dictated by how the economy performs as well as what inflation does. And the economy right now is still performing just okay, and interest rates are still relatively high. At the end of the day, something is going to break in the system, but that doesn't necessarily have to be reflected in the markets in the form of a lengthy bear market. Because remember, the S&P 500 tanked by around 10% in March when SVB collapsed, but it has since rallied more than 15% for the rest of the year. A similar event will happen once again, and it will again mark the bottom for the market in the short term. And in this case, it could be something related to the utility sector or NextEra Energy defaulting on some sort of loan. Because as you can see historically on a seasonality basis, the markets have performed relatively well going into the end of the year. So if you've been curious as to why small cap stocks have been performing and why your portfolio has been red for the past week or so, this right here should have answered that question. As usual, folks, I'm going to be continuing to invest in my favorite stocks and companies and taking advantage of any sort of drawdown that we see, unless something fundamentally changes with the business models of my companies. As usual, let me know your thoughts on the situation down in the comment section below, and thank you very much for watching.